Everyone. My name's Darren. A lot of you will know who I am. For those of you who don't, I'm the business development person at Lesstax2pay, dealing with a lot of the regulatory changes and dealing with you individually. So what today is about is there's a new reporting regime for self-employed and landlords coming in from April 2026. It's called MTD for ITSA. And what we're going to go through today is what does it actually mean for you? What are the reporting requirements, the deadlines and everything else? So this is just going to be very, very informal. If you have any questions, please do not be afraid to post them. There is a Q&A and we will do a little bit of a Q&A session at the end. If you have more personal questions, then please email us and we can then go through them individually with you, obviously privately. So let's just get into it. Everyone's mic is muted, so there will be no sort of cross speaking for everyone. Have no fire alarm due at this building, so hopefully we'll be okay and uninterrupted. So let's just get into it. What does it actually mean? So for MTD for ITSA, it's for income tax self-assessment. That's what the ITSA part stands for. And it's going to affect self-employed people and individual landlords. So if you are a corporate landlord, this does not affect you. You still have the same reporting rules for corporation tax. This system is designed, it was actually announced quite a long time ago when they looked to digitize the tax system, with VAT being the first one that went under this scheme. ITSA was the second one, and then there was a third iteration of corporation tax, which they have subsequently stopped and they're not going to look to do. What this is designed to do is to try and bridge the gap between what HMRC or the government are expecting in tax revenue and what they actually receive by getting more accurate reporting. So this will be, it has to be done on software, or if you keep it on a spreadsheet, it has to be then sent in via bridging software. So then it's all reported, and it gives the government a bit more of a basis to look at you if there is anomalies in between what you've been reporting every quarter and then your tax return. Also gives them the basis of they can see what they do, and HMRC are very good at looking at your social medias and looking at your lifestyles and everything else before they come to you. They have a big, massive database that feeds a lot of information in for them. So this is what the system is designed to do, is it's to digitize it, to make it much more accurate in terms of what they're expecting and what they get. It also gives them much more basis to look into and do an inquiry into your tax return if there is big anomalies between what you've been submitting and everything else. It cannot be done via their website. Like I said at the bottom there, it has to be done via a bookkeeping software, so the likes of Xero, QuickBooks, Sage. There's lots out there. There's a big list of MDT authorized providers, or if you keep your records on on an Excel sheet, you can use bridging software, but there are certain templates that you need to adhere to for that to be compatible with HMRC. So I'd prefer to do it via cloud-based software. So who is this going to affect going forward? So MTD is just, like I said, for self-employed landlords, and it's done over a 3-year phased cohorts, as I call them. So the first people that are going to be affected by this are people with a combined income of self-employment and or land rental income of 50k and above. So that could be that and I'll have a couple of examples in the next slide, but you have the majority of your income via self-employment and you have a little bit of rental income. If it hits that threshold, you are part of that first year. The next year is April 2027 with a combined income of 30k and above again. And then you've got April 2028, which is 20k or above. There's been no mention of anything past that. with reference to being lower than that. There's been no, everyone from April 29, there's been no mention of that yet, but this is government, they can change very quickly. But yeah, so the first lot that are going to really be affected by this is really, I'm going to say mainly your self-employed people that might have majority of their income by self-employment and have a little bit of rental, or if you've got multiple properties that you have that you get a lot of rental income from. Okay, so that's the first year, April 2026. And what it means going forward, like these scenarios, if you're a self-employed contractor with a turnover of 40K, but you also are a 50% owner of a buy-to-let property, your share of the rental income comes to 10, you'll be under the new rules from April 2026. If it was 30K turnover of your self-employment and 10K income from the rental property, you'll go into April 2027. So that's how they're working it out. It's a combination of the two, not one or the other. The only complication on this is if you do fall in under MTD, we actually have to have two separate licenses, one for the self-employment and one for the rental property. So this is where it can get a little bit complicated in reference to filing and making sure that you're compliant. You actually do have to have two licenses. There has been talks of software companies trying to combine it under one, but from my conversations with Sage, QuickBooks, Xero, the sort of three main sort of players in the cloud accounting world, no one's been able to do it yet. But if you are a landlord, there are dedicated landlord tools. One is called Hammock. There is a number out there that are landlord management softwares, which maybe you could run your landlord income through, your rental income through, and do the reporting that way, and then do the self-employment via a more traditional Sage, QuickBooks Xero. That's unfortunately the way that they've set it up. Unfortunately, it has to be two licenses because two forms of income. Scenario 2, you're an PAY employee, but have a buy-to-let property, which you're 100% owner of, and the rental income of the year is 18K. You will not have to comply with the new rules. It's a once-a-year submission rather than having to submit 6 times a year under the MTD rules. So yeah, you would not fall part of the MTD threshold unless they change the lower threshold from 20K to say 10 or 15. That's the only time you would need to obviously be part of it. So that's the scenarios in how they work out what you're part of. We do have to use your 2025 tax return as a guide of which year you fall into. So obviously, if we've done your tax return, I know we've had conversations with some of you already, but if we haven't, we will. And if we're currently doing your tax return, we will then have that conversation once we've done it. So that's how people are going to be affected, and that's how they work it out. With reference to submitting the software, or how often you have to submit your information. So it's quarterly submissions. So the first one will be April 26 to June 26, has to be filed by the end of July, and July 26 to September 26 by the end of October, October to December by the end of January, and then January, March by the end of April. They're the 4 quarterly submissions that we would have to do going forward. A bit like if you were VAT registered, it's the same with reference to quarters. The unfortunate thing here is everyone is under the same quarter. There is no spacing this out. Everyone is under the same reporting timeline. And then we have a final declaration around it, which will be through the software. And then we have to actually do your tax return after this, where we have to collate all this information that we reported 4 times, put it into your tax return along with any other income that doesn't fall part of MTD. So if you've got some pension income or dividend income or savings or any other income that's outside of MTD rules, so it's not rental, then we have to actually put that in your tax return along with the rental if we did have to report it. And then all submissions, like I said before, have to be done by software or bridging software. And it's so they can obviously keep an accurate record. And then, as I said before, there will need to be separate submissions for the self-employment and rental properties. So this is what the unfortunate thing is HMRC have not really advertised this a lot. They've really left it a lot to people like us and other accountants and people just finding out by themselves. We would advocate people to start using software even for the end of this tax year coming up. So from January onwards, just so you get used to it. If you're self-employed, we would look to, if you wanted us to do the MTD submissions for you, we'd look to get you on the software, do sales invoices, hook up your bank feed, and just get used to entering your sales invoices. With reference to your purchase side, we would always advocate, if we are going to do it, we would want to be the ones allocating that and making sure that we have it allocated to the right place. Because if it's allocated to the wrong place, we don't want it that it causes an inquiry because it's your travel's potentially too high because it's been allocated to the wrong place or anything like that, because they do also look at that when they look at the tax return. So that's what we would look to have with you, is a working basis. One thing that also to be getting prepared for this is, if you have not got a separate bank account, if you're a sole trader or rental income landlord, having a separate bank account for this income, not having it in amongst your own personal bank statement and personal bank account, having it in a separate bank account. So if HMRC, if there are inquiries, and this is going to produce a lot more inquiries from HMRC, I can see it coming. When HMRC inquire into the tax return, it's very much about, we need to see the bank statements. I don't want to be giving your bank statements over with all your personal transactions. Yes, we can blank them out and everything else, but it's much easier if it's a completely separate bank account. So if you haven't got one, please get one and start that process of getting everything paid and in and paid out from that bank account if it's to do with your business. If you need money for yourself, transfer it from that bank account to your personal and then go and do what you want with your money and everything else. But with reference to your business, please make sure, certainly with these new rules coming in, that you get a separate business bank account for your landlord rental income and your self-employment. Just so it can be tidy. If HMRC do inquire, we give the relevant bank statements to them. We're not giving your personal bank statements over, as I said before, because while we can blank them, they're looking at the number of transactions and what's going on here and everything else, and it will just pose more questions by them. And we just want to obviously give them the information that they need to see, not what they want to see. So with reference to MTD as well, just so everyone is fully aware, this has been in the works since about 2017. So this is not a current government, this was a previous government looking to digitize the tax system. And it's very much around that they're just progressing forward. We obviously had the budget recently, and we will touch on a couple of points in the budget in a few minutes. But it's very much about the government are making sure that they get what they are supposed to get, really. So that's where we are. With reference to moving forward, what we will do is, if you are into the 2026 cohort due to your income, we will be making contact with you, if we haven't already made contact, and discussing you how we can help you with reference to doing the submissions for you, having the software, what it means for you, what you're likely going to get from us with reference to contact, how the process really works individually for you. I will say this, that the fees will be increasing. due to just the level of, as you can see, the amount of people that are under the same sort of reporting deadlines, and just the amount of it's extra work that we have to do rather than once a year. We're doing it all throughout the year, and the extra software costs and everything else. But we will discuss that with you individually on a case-by-case basis. And we would look to get you on a monthly DD with it as well. So it makes it easier on your cash flow that it's not a big bill at the end. If you're a limited company director and you know that already, that we try and do that. And if it is that you fall under the MTD and you are a director due to rental income or whatever else, we'd incorporate it in your limited company accountancy fee. We would look to put it there and not do a separate charge to you. If you are here and you're not a current client and you want to discuss how we can potentially help you, then the contact details are there, with reference to our telephone number and email address, where we can arrange just going through the process on what it looks like for you. There is a lot of people that are potential, and I don't want people here to do this is bury their head. If we can get in front of it, the software can be a tool to help you, very much with reference to your invoicing and everything else, and we're here to help that and move you forward. We'll also have very active discussions on whether being self-employed is still the right fit for you. I know it's a very, very hard conversation to have with reference to how much tax you're actually going to save. But if it's a case that you are coming to the sort of VAT threshold, we might want to have a discussion with you whether self-employed is actually worthwhile for you. So that's reference MTD in a very, very simplistic form. This is being recorded, so this will be posted out, so you can obviously review this in your own time and everything else. Now, I just want to touch on some budget stuff that we had. Obviously, we had the budget two and a bit weeks ago, and while there was a lot of fanfare and lots of leaks over the period of time, and even the OBR released the complete document before she even spoke, there were some things that we've touched on, a few points here that are really, we're going to see that are really going to affect a lot of our clients. So the first one is dividend tax rates on the basic and higher rates have increased by 2%. So that means that it's gone from 8.75% on the basic rate to 10.75%. And on the higher rate, it's gone from 33.75% to 35.75%. Now, to give you an idea on what that looks like with reference to a tax bill, the example that we've got is currently, if you had you're a limited company director, salary of £9,096, which would have been the director's minimum, a dividend of 40k, your tax bill would have been £3,152.27. With these new rules and new dividend tax rate, and this is again just worked out on the basic tax rate of 10.75%, same salary, same dividends, the tax bill is actually £3,872.80, which means that that's an increase of £720.53p, going from April 2026. So just based on that simplistic view, your tax bill is going to go up personally. We will look at certainly on an individual basis with reference directors going forward, whether increasing the salary and reducing the dividends is a much better overall tax efficient, but it is on a case-by-case basis. Me and Nicola, the day after the budget, I think did 2.5 hours of calculating different salaries and different dividends for people and trying to see a sweet spot for people. But we did say at the end that it would be dependent on their individual case. So we will be having those conversations with you on how we can best manage this going forward. While everyone's got to pay some tax, it's about making it as efficient as possible. So whether that's increasing your salary, paying a little bit of national insurance, we'll look at the overall picture of what you have been paying to versus what you could be paying if we do it this way. And as long as it comes out less in our eyes, then that's a much more tax efficient route for yourself. With reference to the tax rental on properties and savings being increased by 2%. So that means, very simply, your rental income, and that's across the board, so it's your basic, higher, and additional rates, have all gone up by 2% from April 2027. So we've got a year, a good 18 months of this before it goes forward. Simplistically, £10,000 worth of rental income, rental profit. If you're a basic rate taxpayer, you would have paid £2,000. You're now paying £2,200. That's obviously based on that you've got other income that's taken off your personal allowance. That's what that is. And if you're in the 40% tax bracket, you're a higher rate taxpayer. That means it'll go to 42%. And if you're in the additional rate, you're at 47%. So that's what the rental property increase is going to be. There is a little bit of a relief with reference to the interest that you pay. That's gone up from 20% to 22% in line with the additional increase. So where if you had paid £1,000 worth of interest, your tax bill would have been reduced by £200 currently. Going forward from April 27, that will go down, that will decrease your tax bill by £220 on the same example. So it's not a massive increase, but it's a little bit of a increase in extra expenses. Now, they have also, and this is not what's been announced when she spoke, is changed the order on how a tax return is calculated, how your taxes are calculated. So where it used to group all income together, that was non-savings and non-savings and non-dividend, used to all group together. Right now they've split it. So income which is not from property, savings or dividends, so that's your PAYE, rental, any other income that's outside of property, savings and dividends is then calculated first. So that will utilize your personal allowance first, no matter what. Then they would then go to property. And that's worked out on its own basis. Then your savings income is the third one, and then your dividend income is your fourth one. So if your PAYE income and your property income gets you towards that higher rate tax bracket, then your savings allowance drops from £1,000 to to £500, which means you're paying more tax on your savings and you're paying a higher rate of dividend. So this is how they're going to basically get more tax income from you, is they're relying on the people that have savings and dividends or savings and investments. They're going to pay higher taxes because they're going to be forced into the higher tax bracket. Bearing in mind that they've frozen the personal allowances again until 2029 to 2030. This is how they're going to get people into the higher tax bracket. So again, it's about having conversations around what can we do to help minimize that with reference to you. Just so you're fully aware, that's how they're working it out, with reference to the order of the tax calculation in a tax return. My third point there is corporation tax penalties. So this is really for limited companies and directors. Right now, corporation tax penalties, if you're a day late, it's £100. It's going to go to £200. It's going to go, if you're then 3 months late, it was currently £200, which will go to £400. If you're late for 3 years on the trot, that again was £500, it'll be going to £1,000. And if you're 3 years late and it's then more than three months, it's currently £1,000, but it will go to £2,000. So this is about us just making sure, obviously getting the corporation tax returns in on time with reference to your paperwork, getting the accounts done on time. So when we're requesting paperwork, we just need to make that, because unfortunately that's just wasted money really, to be honest. But that's coming in from April 2026. So just be mindful of that they are looking to punish people that are consistently late with reference to their filings. That, like I said, corporation tax to do with limited companies. Soft landing period for MTD for ITSA for the first year. So there will be a penalty point system in place for MTD for ITSA. This will be very much around a bit like VAT, that if you do a non-submission, you get a penalty point, you have a threshold of penalty points, and then you'll get fined. Now, what they're saying is for the first year, the April 2026 cohort will not have that issue in the first year. From April 2027, whether it's your first year, so if you come in on the April 2027 cohort, you're not going to have this soft landing period. It is going to be from day one, you have a potential getting a penalty point if you don't file on time. Now, generally with VAT, it's 4 penalty points, then it's a fine. If they're going to look to run a very, very similar system and they haven't announced what the penalty points are and how they run, but there is big rumours that it's going to be very, very similar to the VAT penalty regime, which is 4 penalty points, and then it's a £200 penalty. With reference to, you then have to get all your submissions in for a year on time for the penalty points to go away, and then they reset to 0. But then if you're late consistently, the penalties do go up as to how many times you are late. So there is a period of bedding in, certainly with the first year for this. So we can obviously make sure that, one, our systems are all up to speed with reference to requesting paperwork, and also for you with reference to being the first cohort, is getting used to this going forward. But like I said, if you're in the April 27 or April 28 cohort, this is not going to be, there's going to be no soft landing period with this. And then the last point on the budget news is e-invoicing. So there has been a big thing in mainland Europe about e-invoicing, business to business. So it's done through electronic software. It's sent to the customer or the supplier, and then they take it from there. Now, for us, this is becoming mandatory in 2029, so we've still got a few years left, but it's going to be mandatory for business to business and business to government from April 29, the e-invoicing. So no more paper invoices. Not that I'd expect a government agency to accept paper invoices, but apparently they do. So yeah, so this is going to be that you have to run your sales through software. Again, we can talk to you about that. We're very, very much trying to get people to start using software and see the benefits of using software, where you can keep track of who owes you money, what you've been doing. You can look at reports inside there, and it's very much a tool that can be used, and it can automate. So if you have recurring invoices to customers, it can automate that process and do it for you without you even needing to do it. So it cuts down that admin time. So with reference to that, that's very much the basis of the webinar today. Just to recap, this is affecting landlords and self-employed. You have to have a combined turnover of 50k or more to be April 2026, 30k or more for April 2027, and 20k or more for April 2028. You'd have to do quarterly submissions through the software, plus a final declaration, and then the actual tax return. So this does seem quite a big sort of change. It's a massive change in the self-assessment industry. So it's about obviously managing your processes, and we're very much going to be holding your hands through this and helping you as much as we can. Obviously, if you want us to do the returns and do the submissions, that's absolutely fine. We can do that. We will do the requests, and it'll be very similar to our VAT requests. It'll be done on the end of the month and then every 7 days after that. But it will need you to obviously bring the information in a timely manner. But if we can get you that you're doing part of the process with reference to your sales and having a bank feed there just to help you, it will help everyone moving forward. So that's it from me. I'm just going to look at the Q&A. I can't see that anyone's actually posted anything question-wise. If you do have any questions, please do not hesitate to contact us. And I can see Nigel from our Portsmouth office is in here. If you're a Portsmouth client, please do not hesitate to contact Nigel as well. And that's it from us. It's very much a massive change for people. But like I said, do not be afraid to contact. We'll be making contact with you if you do feel of it. If you're not a current client and you want to have a conversation, we can have the conversation and see if we can help you. But thank you everyone for coming, and we'll speak to you soon.